Good morning, good afternoon, good evening, and it has been another month, so it is another video. I'm Taylor Watson, What's Investing, and today we're doing our Sharesies challenge, which we do every month, and we take a look at our portfolio, the dividends received over time, and we have a guess at it. And whoever wins each month gets a shout out, if they can beat me, of course. And for every subscriber we gain, we put in $1 to Triple M, and for each video we now make for the channel, we put in $25 as well. So over the course of the month, I made one video between the last challenge, that's 25 bucks itself, and then this video itself is another 25. But during the month, we decided to put that 25 in early for the last video, just because Triple M did have a dip here, as you can see, or maybe even there. So we decided to put in the 25 early for that video, but we're still going to put in the 25 for this video now. And that is the general basis of the challenge. For this month, we haven't gained any subscribers in the challenge, so we won't be putting $1 for any of those. But if you are a frequent viewer and you do enjoy these type of videos, feel free to hit the button and follow along with the journey. But to get straight into it, we will look at how many dividends we received in February and how that's looking compared to the guesses. So my guess was $16.48 for the month of February, and we achieved a total of, where are we looking there, $15.05, and the guesses were above, and above. So I win this month. Very close though, because if anyone went even a cent below me, or even like down to like $14, they would have had it. But yeah, I was off by $1.33, and Trish was off by just about $2, and then the rest is just more and more. So it looks like I'm the winner for this month's guess, as I do have the advantage of sometimes seeing the dividends early, and I'll hide those ones. You can already see them, but hide the ones that have already come in March. I know what they are and you don't, so I have a slight advantage of knowledge and asymmetric information to help me with my guesses, and I know my exact stocks and shares and stuff, so if you do beat me, that's why you do deserve a shout out. But yeah, so we've received $15.05 for the month of February, and that's bringing up our averages. So as you can see, we did change these graphs. If you are a frequent viewer, these used to be like line graphs and stuff. I decided to try them out being bar graphs just to see if it looks nicer or something, and I think it does. It fills in a bit more empty space, adds a bit more color, and feels easier to read. Yeah, and I don't know if this was in the last video, but I added a trailing 12-month dividend graph. I think I did it right, but that's just to see kind of how much in yearly dividends we're expecting, and how much our portfolio can really do. And yeah, the average dividends received per month is basically the total received over time divided by the months we've done, so the scale is just downwards pretty much. And yeah, the dividends per month gives us an indication on the big months from the New Zealand semi-annual companies, and generally the months that are really small, and we get to see if those really small ones are getting bigger. So over time, March has been tiny, gets a bit bigger here, and then this year it's going to be even bigger. Same with February. Back in 2020 we hit maybe a few cents, you can't even see it. Then February last year we hit $5, and then February this year we're on 15. And a better way to look at that is to see our monthly dividends here, and to really see the comparison showing as each year it has a different color and a different bar, and we're seeing that staircase for each month just go up and up and up and up. April this year will be a bit different, possibly. It depends when Hallensteins does pay, as that is most of the December and April dividends, because one time they did pay in, I think it may have been June, or it may have been September. Yeah, it was September in 2020. So it really depends when they pay it out. If COVID forces them to put it later, hold it, or maybe even cancel it. But if we don't receive that dividend this year, we will not be hitting our goal or anywhere close. We are relying on that dividend to hit our goal of $333 of dividends. But we are well on our way. The trend line is currently we are far under what we need to be hitting, like 20, like 30, 25, $30 a month. So we are below the mark on these two. March, I think we're going to be hitting closer to $20, $25 in dividends, and then the Helen signs will bring it up. So I think we will be below our goal possibly, but as we invest more and more, companies do their dividends raises, and we possibly get some discounts on the companies for bigger dividends, we do have an opportunity to grow towards that goal, and possibly we will learn how to set smarter and smarter goals that are actually more attainable, but still a challenge into the future. So my guess for the month of March will be, I'll go bang on $20 for March. And yeah, feel free to give it a go yourself. Just head to the comments section and give the dividends a guess for how much we'll receive in total in March. You would have seen a few sneak peeks at some dividends that have already been paid. I think the Global X High Yield ETF was $3.48 and Visa was 44 cents, so roughly already at $4 with those two, and there was another 3 that have already been paid, which you wouldn't have seen because I blanked it out, but you can have an indication of where it's heading, and we're only not even halfway through the month. And if you did see here in Triple M, we do have a dividend incoming of $4, which will be roughly 5.6 to 6 NZD, and I believe that's paying in March, so that gives you another indication of where to lead your guess. But yeah, that's enough for the spreadsheet just for now, and we'll just give the portfolio a general look over. So in terms of our goal, we've topped up 1,375 this year, and we're moving pretty much on track to hit our goal of investing $21,000 of our total money into Sharesies and Hatch. And yeah, we've just been doing little top-ups here and there depending on how many hours we work on the week before. And then this bigger one is generally just if the stock market has a big dip, I'll cut into some different areas where I find the cash. And then this one was from our Earth 2 sale, which we just made a video on previously, where we sold pretty much everything out of our Earth 2 and made a hefty profit on that, and that was super sick. I'm pretty stoked on how that kind of speculative investment went. It could have gone poorly, but that's why I'm stoked. In terms of Apple, we've slowly been chipping our way at it, buying every once in a while, especially when it dipped in here. And since it has scaled its way back down to that kind of same range, I will be buying some of Apple with this remaining $30 we've got. AT&T, I think we're pretty comfortable where we are. We might buy another bit here when we get more and more cash coming in, as it is doing kind of a split off of the company's assets, and its streaming service is going to combine with Discovery, I think, or it's Universal or something, and the dividend will be cut into roughly 45% of what it is, so that is a big reason why the dividend has taken such a massive hit, but it is an opportunity to still buy a decent yielding company anyway. Our smallest investment is currently like Colgate and Procter & Gamble. We've re-updated our weightings chart and everything, and we've taken out the companies that we've sold recently, all of those New Zealand energy and infrastructure ones, just to take advantage of the American dip. And I think it's going to do well for us. We will be missing out on lots of those $3 to $4 dividends from the New Zealand energy companies, which may hit on our goal, but it's really about getting that long-term growth and that sustainable kind of investment path that we want going forward. Yeah, Helen Signs itself has taken a big hit in New Zealand. I've done a few buys here and there, but I've kind of hit a point where I think I'm comfortable with where I am with Helen Signs. I might decide to buy more in the future, but I'm pretty happy with where it's at the moment, just letting those massive dividends kind of pay its investment back over time and just grow that for free. The ETF did take a massive hit, heading towards 15-20% hit at its lowest points, and yeah, we've been averaging into that. It's a low yield, but it is a general way to diversify, so that's one of our bigger holdings just because of that. And yeah, we've just been averaging into all of these. McDonald's did take a big hit recently, so we did put more money into there, as we hadn't been buying that one too frequently or with too big of a stake. Same with Microsoft, buying more of that. NZX took a whopping hit as well, so it dropped 20% or something like that, and its yield is fairly high, so we took advantage of that, and I think I bought another $100 or more, so we've got 256 shares, and we did have 145 beforehand, and this dividend, sneak peek again, this dividend of $5 in March already was actually only off 175 shares, so the next dividend is going to be closer to that $7 range if it's paid the same per share. So that's super cool to know that, just knowing that the next dividend is going to be even bigger. Yeah. Other than that, not too much is different down here. We haven't been buying these too much. Bit of Tesla, of course, as it's been bobbling around. We've been buying here and there and just keeping up with that dollar cost averaging strategy that we've been trying to hone in more. Walt Disney and Visa, definitely buy more of them. Westpac, not too much really. Did buy a lot of this dip here, but not really much recently. And that's generally what the portfolio is looking at. Our value is at $17,000, which is not too shabby, but our return has taken a massive hit. You'll see that it's at $2,000 currently. But if we go to a closer view, we were peaking at 19 grand before we'd invested this like $1,300 we've already done, and it also was up 5.6 grand. So we've lost 3,400 in unrealized gains, or fake money as some people like to call it. But it has taken a hit on our portfolio. But that is the good cool thing about the investing is over time, once we do get these compounded dividends, get these nice dollar cost averages, and when we get these discounts, like in the COVID 2020, we buy companies super cheap, then they recover to where they actually are valued at, or their earnings aren't hit as much as people would expect. We have kind of a fallback if something material is happening to these companies now, and they take a 20% hit. We can bear that because we're already up on them, and it's a nice comfortable way to kind of keep the money rolling in. Other than that, Lucas' portfolio has just been chilling. It's on the down. I chucked in $10 towards the ARK Innovation ETF because it slid down to a point where I was like, yeah, why not? It's $10 for the nephew. You know, his birthday's coming up. Got to give him a cheeky investment into something. And then we've just been buying every once in a while into the S&P 500 as well. And yeah, we put in a few bucks here and there just for the nephew. And he's roughly, like 4 years old. So in another 14 years, I can give this account to him when he's 18, I think it is. It's like a boom, you're an adult, here's your investing strategy that I've been doing, have a go at it or whatnot, or I can hold it until he's 25, I believe, then it's like forcefully given to him. I think that's what it read out to be. But yeah, that's something cool I'm doing over time, and once he's a bit more older, maybe in his teens, I can maybe start teaching him what I know and what I don't know. So that'll be a cool experience. And yeah, other than that, Hatch, the Tesla holding, has just been exactly following the Tesla stock, just kind of been chilling. Not really going to touch this at all, we'll just kind of have it there as a show of value. But we'll look at the spreadsheet a little bit more. So the weightings, we just updated this before, and it is still moving because the market is open. But yeah, we did get rid of our Chorus, Meridian Energy, Trustpower, Spark, and all that out of New Zealand. And now smallest holdings are actually Procter & Gamble, Pepsi, Fisher & Paykel, Colgate, and Somerset. And we will be looking to dollar cost average into all of those, trying to get them all above the $300 to $400 line. Kind of just wanting to get those smaller positions to be a bit more impactful in the portfolio and get their dividends up because they are all valuable companies. And yeah, Tesla is still holding its like 40% reign, even though it is it's down so much from its all-time high. If it did go to its $1,200 all-time high, this would be more looking like 50%, 55% or more. But the top three companies do hold a 53% weighting in the portfolio, and if we do like the top 5 stocks, it's over 60%, which is maybe not the best strategy for everyone. This is comfortable for me, and I think it will be good in the long run. Other than that, we've got our dividend chart here, and this is not based on time. This is just each dividend paid by the company in order of when it was paid. Just no timing on it, because some of these pay semi-annual, some of them are quarterly. Some of them I bought before the other, some of them are monthly, some of them cancelled a dividend once or twice, some of them pushed them, so they're in no time proportion to each other, they're just when the dividend was paid by that company. Yeah, so I just like to look at it as a staircase. They're all going up. Some of them I don't invest in very often, so some of the going up is just a little bit of reinvestment. It'll be pretty negligible as the yields are like 2 to 4%, so it'll be like maybe a cent or two extra is that compounding, or even just a dividend raise of 10% or 15% on Visa can actually have a hit, because if it was 30 cents, now it'll be like 32 or something like that. And when we get those dividends up past the dollar range, let's say if the Visa one was at $10 and then they do a 20% dividend yield increase, it's like, well, now I'll get $12. So that'll be much more cool to look at those numbers when they're actually a bit more material. But yeah, I just love looking at all these different American companies, New Zealand companies, and just seeing where the trend line's going for all of them. And of course, most of it is based on capital allocation into them. But it is still really cool to see, and the monthly ones make me chuckle a little bit when I look at them, just because there's so many more bars. But it is cool to just see where the money is coming from, and AT&T will look very different when it gets that cut. But yeah, and this is our new monthly high yield that we've been putting our money into, and obviously here we chucked in a lot more because it had like a 10 or 15% drop in the stock price, so we bought more. And put a bit more risk into it, and yeah, some of that money, or most of it, will be reinvesting into itself at the moment, but once it gets to a point where it can, I don't know, say it's like a 10 to 13% yield when I'm buying it, so say it gets to a point where, I don't know, it'll pay itself off pretty quickly, maybe I'll just start investing all its money into other companies and just use it as like another income to invest into other companies, because it's not a small dividend per month. Say it averages $3 per month now, that's $36 a year. That's about how much I'd invest into, I don't know, Procter & Gamble currently. So it's a cool way to just save some money out of pocket to invest in other companies a little bit. Other than that, we have this little boring page where we've just got how much we've invested, what our goal is, and how much we need to roughly invest per week to hit that. So sitting around 100 is pretty comfortable for me. I've just finished paying back a benefit system in New Zealand because they overpaid me, and then I had to pay them back. So I just finished paying that back. So now I've got a little bit more per week to put towards investing now, which is super cool. Finished paying off something else, and yeah, the tax, the end of the financial year is coming up, so I will either have to pay plenty in tax or I will get some in return. I think I'm looking at getting some in return because I seem to be getting taxed way over what I should be in my pay slips, which I may email the IRD about because I'm not fully sure they're doing it correctly, as I thought it was pay as you earn and incrementally go up as you pass the thresholds, not estimate what you're meant to earn for the full year and then tax you on that average rate, because that's, I don't know, it seems like a bad way to automate it. If I do just stop working, then I've been overtaxed for the whole year and I'm missing out on money at every point in time when you could just automate it to be correct the whole time. Maybe it's not as simple as I'm looking at it, but I think even with my like self-employed and private earnings that I have to report, I will probably get tax paid back rather than have to pay them more, which could be nice. Could be nice to get $100 back or something. But yeah, other than that, we're keeping our net worth tracker going. Hopefully over the coming months we'll see this steadily get closer and closer to that break-even point of zero, and then I think we deserve to have a drink. That's for sure. Getting a $37,000 loan and then a $7,000 loan here, and then some other things, and then being able to pay that all back and kind of invest parts of it is super cool, and just being able to see the trends on our spending and savings and what we're up to, and then it's looking pretty good. So we've seen our total debt climb until I think November was our highest point of debt, 43,300, and now we've chomped that back to 42,500. So we've been paying some back through the automation of paying the student loan back through working, and then I've been paying back my parents every week some of that. So we've clawed back $800 of that roughly. Our KiwiSaver's gone up, not too much recently. It's kind of at an all-time high, but it's been going up based on our earnings from work and a little bit of gain. Our portfolio is down technically 3,000 from its all-time high, but that all-time high may have just been a fake in the market. Something's overpriced, but it's sitting really nicely where it is. And then our just savings and spending money is just kind of still there because it's still money I have in pocket. But yeah, seeing that decline $1,000 over a few months is super cool. Yeah, as we close out more and more debt and earn more and more and get that compounding going, it'll become easier and easier. I guess with inflation, interest rates going up, and inflation itself and minimum wage going up and all that, things will be easier and easier to pay off. And not everything is bad for the little guy. Some things we can take the small wins on. But yeah, that is pretty much the summary of the portfolio. This is everything that has been going on, and hopefully we get this final bit of March Q1 higher than Q3 of last year, and it's already higher than Q1 of last year with just 2 months, and that is something in itself which is super cool. And yeah, I think that's about it. We've got $21 for the 2 months. Our guess for March is $20. And if you haven't checked out our best investment yet, check out the last video where we talk about my Earth 2 investment, the process of how I got that money out, and generally why I sold the money and how much the return was. It's a pretty juicy one. It's better than my Tesla investment so far, mainly because Tesla is down from its all-time high, but it was bigger than this number. But it is a speculative investment I probably wouldn't do again. And I think this one's going to be a lot bigger in the future. But yeah, other than that, I'll definitely see you guys in a week or two for the next video, and then next month for the March dividends. Peace. Happy investing.